today. The first topic, we are going to look at financial statements, then also the analysis and interpretation of these statements, and then the two smaller topics, VAT, and together with that the ethics, as well as cost calculations. So let's start with the first one, financial statements. To make sure you know where we are in the accounting cycle, I'm just showing this to you again. We've done transactions. That's what we've done since grade 8 and 9, but also at the beginning of grade 10, the source document, the piece of paper that must be completed. Then we've captured that in the journals, mostly term 1 work. We've introduced you to more journals. Then we posted those to the general ledger, debtors and creditors ledger, and then the trial balance. Now we are at the end of the financial year, the 12th trial balance. And from there we do the financial statements, analysis and interpretation. So that is where we are now. Pre-adjustment trial balance, that is the 12th trial balance of the year. Now we call it a pre-adjustment trial balance. Then we have to do the year-end adjustments, already introduced to you in the second term. Then we prepare the post-adjustment trial balance. We do the closing transfers, also done in the second term, where we close off the nominal accounts to the trading account and the profit and loss account. We prepare the post-closing trial balance, and now the financial statements, analysis and interpretation. So this is where we are in this whole process. Important that you have a picture. A reminder, the post-adjustment trial balance, that's your longest trial balance, and the post-closing trial balance, your shortest one, and that information in that one is the same as the information in the statement of financial position. And just remember, we are at the end of the financial year. And certain things must happen at the end of the year where we calculate the net profit, where we show our financial statements. We have two financial statements. The statement of comprehensive income, your textbooks will most probably still show income statement. It's the same thing. Statement of financial position or the balance sheet. In the statement of comprehensive income, we calculate the net profit for the year. In the second term, you've done the trading account and the profit and loss account. And in the profit and loss account, you calculated the net profit. Now we're going to use that same information, but just in a statement form. Then the statement of financial position will show the financial position on a specific date. It's as if you take a photo of the business on that date and you put it in a statement. We call it the balance sheet. Adjustments, you've already done these adjustments. When we've done the trading account and the profit and loss account, you know how to calculate depreciation. Bad debts, that's actually a normal general journal entry that you've done previously the year. Trading stock deficit or surplus, end of the year, where we must compare. Consumable stores on hand, the stationery or the packing material or the consumables that we still have on hand. If there's a worker left out of the salaries or wages journal, that can also be adjustment. And then these four: accrued expenses, accrued income, prepaid expenses, and income received in advance. Those four. Nothing new to you. We've already introduced you to these adjustments. Just remember, accrued means we add. Accrued A, we add A. In advance means we subtract. This is the matching concept. We want to calculate the real income or the real expense for the financial year. Whether we paid in advance, whether we've received too little, we want to calculate the correct income, the correct expense. Matching concept. That's why accrued, we must still receive or pay, so we add, in advance we subtract. Very often you will say that accounting doesn't have any study work. You don't have to study anything. You must just understand. But that's actually a lie, because you do need to know the format of your financial statements. Now, I know at the beginning, when we introduced this to you in grade 10, it's a lot of information, a lot of sort of new terminology that we use, big words. But please do yourself a favor and make sure you know the format. On a blank piece of paper, you must be able to write down the format of the income statement and the balance sheet without any amounts, but just the format. You will do yourself a huge favor if you study this. This will help you in class, this will help you with homework, because I know you sit and then you just turn back to the previous activity and see what you did there and just copy from the previous one. But save yourself the time, study the format to make sure you can just start with your activity and write down the information. And I hope that in today's session I will help you with that. The first one, Statement of Comprehensive Income. How can I help you? We know that in the Statement of Comprehensive Income, the information is taken from the nominal section of the trial balance, the bottom part, which starts with sales, cost of sales, and debtors allowance. You also know from the trading account that you've already done that gross profit equals sales minus cost of sales. And that is how we start the statement. Sales minus cost of sales will give you the gross profit. Then you know from the profit and loss account that the net profit equals your gross profit plus income minus expenses. So let's do this. Other income, and obviously these income items will be listed there. We add it together in the block, show the total at the top of the block, and that will give us the gross operating income. Minus the expenses will give you the operating profit. So that is your trading account and your profit and loss account in a statement format. Obviously, again, the expenses will be listed. The only difference is, according to the materiality concept, we must show interest separately. In the profit and loss account, we've shown interest income with the other income accounts on the credit side of the profit and loss, and we've shown the interest expense on the debit side together with all the other expenses. But in the statement of comprehensive income, we just show the interest income separately. We get the net profit before interest expense, we subtract interest expense, and then we get the net profit for the year. So I hope this will help you in memorizing the format of your statement of comprehensive income. Statement of financial position. This is normally one that you sort of struggle with. You know since grade 8 that assets equal owner's equity plus liability. And that is exactly what we see in the balance sheet. Assets equal equity and liabilities. We know assets, we have non-current assets and current assets. Equity and liabilities consist of owner's equity, non-current liabilities, and current liabilities. Can you see how we are completing this puzzle? Non-current assets, that will be your fixed assets, fixed deposit. In the block, at the top of the block, the total. Current assets, you have inventory, trade and other receivables, cash and cash equivalents. Total of the block, next to current assets, and then you have the total assets. Non-current plus the current assets will give you the total assets. When we move down to the bottom part, equity and liabilities, owner's equity, we have a note for that where we calculate the owner's equity. Non-current liabilities, that will be your long-term loan. Current liabilities, trade and other payables, bank overdraft must be shown separately on the statement. The moment that your bank is in the negative, it's not an asset anymore, it becomes a liability. So it moves from current assets to current liabilities. and then the short-term part of the loan, that part of the loan that we must repay within the next 12 months, will be a short-term part, and that will be a current liability, moving it from non-current liability to the current liabilities. And then we have the total equity and liability. Assets equals owner's equity plus liabilities. We know that we have notes. Note number 1 and 2 is on the statement of comprehensive income, interest expense. We have a note for fixed assets. We will complete that in an activity later. Then we have a note for inventory, where we can see, we only see the total on the balance sheet. This is a one-page statement. But to see the details, we go to the notes. Trade and other receivables, trade, debtors, accrued income, prepaid expenses, there's a note. Cash and cash equivalents, there's a note. Owner's equity, this is actually the capital account that we just show in a note format. The loan, no note there. Trade and other payables, creditors, accrued expense, and income received in advance will be shown on the note. But as a one-pager, we have the face of the financial statement of the financial position, but the details in the note. Now, how do we answer these questions in an exam or a test? First thing that you do is you complete the pre-adjustment amounts on the statement and the notes in the correct place. And these are easy marks because you've got this on your question paper. You just have to rewrite it, and again, you must know the format. Then you start with adjustments in the sequence given. Some of those adjustments will be easy, some of them will be more difficult. Then you complete the line totals, you add up, and then you calculate the subtotals and the totals on the statement and the notes. And here you can earn a lot of method marks if you've calculated it correctly and if you know your format and the format is correct. Then you can earn a lot of method marks, specifically on the statement of financial position. We are going to do two activities. Activity 1 is on a statement of comprehensive income, and activity 2 will be on the statement of financial position. In your revision booklet, this is page 3 to 7, and in your answer book, it is page 2 to 6. So you can see that you have that ready so that you can work with me. Activity 1, those first 5 questions, that is general accepted accounting principles, your GAAP principles, you can do that on your own. I'm going to do with you the statement of comprehensive income, and then they ask us a question here: will the bank account balance be a current asset or a current liability? And we have to give a reason for that. Very important to know your financial year. Remember, we said that we are at the end of the financial year. If it ends on the 28th of February, it had to start on the 1st of March 2021. And here is our year end, the 28th of February 2022. So that whenever they give us a date, you know it is beginning of the year, or is it the end of the year, or is it somewhere during the year. Extract that they give you, just check whatever is given in brackets. That means that's your accumulated depreciation at the beginning of the year, 1st of March 2021. There we see bank credit balance. So we already know the answer to that question. Bank will be a current liability. Why? Because it has a credit balance. It's shown as a credit balance of 12,600, a bank overdraft. We've got a loan, creditors, sales, cost of sales, and here you see we are working with the nominal account section of the trial balance in order to complete the income statement of comprehensive income. We start with sales, cost of sales, debtors allowance. Then for the income, you look at the credit side of your trial balance. All the credits, but obviously interest must be shown separately. Expenses, you look at the debit side, those will all be your expenses, but obviously interest on loan must be shown separately and interest on overdraft must be shown separately. There you have the adjustments, but remember we said step 1, we transfer the amounts on the pre-adjustment trial balance to the answer sheet. We know sales, we must subtract cost of debtors allowance. So immediately subtract debtors allowance. Now I've already put in the pre-adjusted amounts in blue. The rest was given to you, but the blue ones is what you are supposed to enter in step number 1. They gave you 4 of the expenses. These expenses were not added. So you have to add that. And here at the bottom, operating profit, interest income, profit before interest expense, and then interest expense, they've given us the 29,000 interest on loan. They also given us interest on overdraft. Later on we'll see that we also put that in the note. So now we're ready with step 2. Step 2, we start with the adjustments as it is given, the sequence that it is given. We don't start from the bottom to work upwards from the statement to the adjustments. We start with adjustments and we work through them. The first one, the account of a debtor must be written off as irrecoverable. The 2 accounts involved, bad debts, expense that must be debited, and debtors control must be credited. Now this is on the balance sheet, not applicable now, but statement of comprehensive income, yes, we must add to bad debts the 350. The second one, received 700 Rand, we received money, therefore bank will be debited. From a debtor oblige whose account was written off, previous year, written off. Now we receive money. We debit bank, but we are not going to credit the debtor because that debtor does not exist anymore. But we are going to credit bad debts recovered. This is an income account that we will now credit. So let's do those first 2. Remember bank, this is on the balance sheet, not asked. Bad debts recover is an income on the statement of comprehensive income. Bad debts, a 350 to be added to bad debts, so that will give you 2,450. And bad debts recovered, there is another 700 Rand, so that the total of bad debts recovered gives you 1,500. So we're done with adjustment 1 and 2. We can move on to number 3. Depreciation. Equipment, 10% per annum on the cost price. And then they say new equipment with a cost price of 55,000 was purchased and recorded. Important, and recorded. It was already recorded. We already credited bank and we already debited equipment on the 30th of November. Now for the new one, always when you bought new assets, always show your calculation as 2. The new one we bought for 55,000. We write off 10% per annum, but we did not have that for a whole year. Our year starts on the 1st of March. March, April, May, June, July, August, September, October, November, December, January, February, end of the year. We bought this on the 30th of November. So we can only write off depreciation for 3 months. Because we only had that equipment for 3 months, 1375. Now the equipment figure that they gave us, 132,000, that was at the end of the year. We had equipment for 132,000. But that was after we bought the 55. So we must subtract that 55 in order to get the old or the equipment that we had for the whole year and calculate 10% of that, which will give you 7,700. On vehicles, 15% per annum on the diminishing balance method. There was no additional vehicles bought. Remember, diminishing balance value is on the carrying value. And we know carrying value equals your cost price minus accumulated depreciation. The cost price of the vehicles given, 190,000. And the accumulated depreciation on vehicles, 36,400. And that was for the whole year, 15%, and that will give us 23,040. On the statement of comprehensive income, we are going to show those 3 amounts separately. Depreciation is an expense to be added, not on the pre-adjustment trial balance, because this is something that we do at the end of the year. The 1375 of the equipment, the new equipment, the equipment that we had for the whole year, and then on the vehicles that we wrote off. So the total depreciation, 32,115. Now in grade 10, this can earn you up to 7 marks. So please make sure that you show your calculations. Yes, you can calculate it somewhere on the question paper, but when you answer this on your answer sheet, make sure you write it next to depreciation and write the 3 separate amounts. Depreciation is something that we're going to do in grade 11 and grade 12, so make sure that you understand it in grade 10. Just to show you, vehicles, that was the 190,000 minus the 36,400 accumulated depreciation. The next one is on the loan. Now they show the loan at the end of the year as 300,000. The adjustment says the loan from Bank, the annual installment 20,000 was paid on the 1st of September and correctly recorded. Again, that very important sentence. I always say that in accounting you must read it 3 times. Read 3 times, you think twice, and then you only write once. So please read the whole sentence. Read until the end of the transaction. Make sure that you don't assume certain information given, but that you read it until the end. In this case, they said, and correctly recorded. So we've already credited bank, we've already debited the loan, and we must provide for 15% still payable. So we know this is accrued expense. We must still pay the interest on the loan, or some of it. If we go to our year, we've paid on the 1st of September. That is where we've paid. So if we count 1, 2, 3, 4, 5, 6 months, and then 1, 2, 3, 4, 5, 6 months after we've paid the 20,000. Now we've seen that the loan amount given is 300,000, but that was after we repaid. So at the beginning of the year, it was 320,000. 15% per annum for 6 months. And that gives us a 24,000. Then we repaid 20,000. So now there is 300,000 left, on which we must pay 15%, but only for 6 months. and that will give you 22,500. So the total interest on loan is 46,500. This is how much it is supposed to be. That's what we just calculated. How much is the interest supposed to be? Now if we look on the pre-adjustment trial balance, we will see the amount for interest expense was only 29,000. So there is an accrued accrued expense of 17,500 that we must still pay. 29,000 plus 17,500 will give you that 46,500 accrued expense. Accrued we add. Okay, so that was the interest on the loan that we had to calculate. Number 5, the owner donated goods on behalf of the business. So this is not drawings, this is donations to the local orphanage at cost price. They already gave us the cost price, so that's fine. But this transaction has not been recorded. Donations is an expense that must be debited. What did we donate? We donated trading stock. So trading stock must be credited, asset that decreases. So on the income statement, we must add 2,500 donations because we don't see donations on the pre-adjustment trial balance yet. Number 6, goods with a cost price, okay, luckily they gave us the cost price again, was returned to a creditor. And again, no entry was made. We returned stock. So our trading stock will decrease. But our creditors will also decrease. But creditors, this is shown on the balance sheet. The trading stock deficit will be influenced by these two adjustments. That's why number 7, after the physical stock take, we have on hand 35,800 trading stock. Now we teach you that the difference between what is in our books and what we've counted is the trading stock deficit or the surplus. But before we came to number 7, there was 2 adjustments that will also affect the trading stock. We know there's going to be a trading stock deficit. The amount given on the pre-adjustment trial balance, 43,400. We know we must subtract what we've counted, the 35,800. But in between, there is something influencing this amount. The owner donated, the donations, as well as the returns of the stock to the creditor. Donations not yet recorded, so that 2,500 donations must still be shown in the statement of comprehensive income. Trading stock deficit 3,260. The 35,800, this is the amount that will be shown on the balance sheet, statement of financial position, because this is how much stock we have on hand. Still part of that number 7, and here again we have to read. Very often we see stationery and we know we must subtract the 4,100, and we skip that part of the information, which is critical. Stationery used during the year, not on hand, but used during the year. And that is what we want to calculate or show in the statement of comprehensive income. How much have we used? Stationery, 4,100. The other option is they give you what's on hand and we subtract to get what we've used, but now they give us what was used. Matching concept, the real expense for stationery. So read carefully. Number 8. The rent for February has not yet been received. So we know this is accrued income. We haven't received the rent for 1 month. Rent increased by 650 per month from the 1st of September. Our year starts March, April, May, June, July, August, September, October, November, December, January, February, year end. But we haven't received the rent for February, and we've increased the rent on the 1st of September. Again, get yourself into the habit of showing the timeline. Sometimes you are not sure of the months of the year, so please make sure that you know the order. Maybe before you start writing your paper, write it at the top. When we count months, you start counting on your fingers, which is 100% correct, but now you've got a pen in your hand and you don't know whether it's 8 or 9. Or you've got your calculator and you work with your calculator and you one hand and you want to try and count on your fingers and you get confused. Write down the timeline. Make sure you know the order of your months. And then immediately when you draw your lines, you will see the information just sort of falls into place. So I know it is a lot of effort, but write that down. 1, 2, 3, 4, 5, 6 months. It was a certain amount. We don't know how much. Then for 5 months, we've received the original amount plus the increase of 650. And that gave us the 28,000 on the pre-adjustment trial balance that we've received. And now we just solve for X, because X will be before the increase, and then we just add a 650 in order to get the amount that we are still supposed to receive for February. We multiply that one in, 5x plus 3,250. We know we can add those two. We want to get rid of the 3,250. We subtract it from the 28,000, 24,750, and if we solve X, 2,250. That was before the increase. So our accrued income will be the 2,250 plus that increase of 650 to give us a 2,900 that we are still supposed to receive for rent. Or you can take the 28,000. You can say that for 5 months we've received 650 more per month. So in total we've received 3,250 extra. So let's subtract that 3,250 from the 28,000 that we've received, and then we can just divide it by 11 to get the original amount, how much it was supposed to be. And then yet again, the 2,250 plus the increase of 650 will give you 2,900. Doesn't matter which method you use, as long as you use the method that makes sense to you. So rent income accrued, add 2,900. Also, water and electricity, we've got a 3,200 that's not been paid yet, and telephone, still payable. That is accrued expense, so we need to add that to water and electricity and telephone as well. Rent income, accrued, we must add, and we said that was 2,900 that we must still receive for rent, so that the real rent income is 30,900. Water and electricity, there was an accrued expense of 3,200. So after we've applied the matching concept, our real expense for water and electricity, 28,880. Telephone, there's another telephone account that we haven't paid yet, therefore 21,490. These are normally your easy adjustments. easy marks that you can earn for that. And then the last one, an annual insurance premium. Annual, that is for a year, 4,800, was paid in full on the 1st of October 2021. It was paid in full. I'm going to use that timeline again. On the 1st of October. 1, 2, 3, 4, 5 months is within my financial year, but I've paid for a year. So the other 7 months is in advance. This is for a year. So the 4,800 was for a year, of which 7 months is in advance for the next financial year. So 2,800 in advance. When it's in advance, we subtract because we've already paid for the next financial year, but it cannot count as an expense for this year. Insurance, prepaid, subtract 2,800 to give us the 4,850. We are done with step 2. Step 1, we did the pre-adjustment amounts. Step 2, we've worked through the adjustments. Step 3 and 4 is where we calculate the total of the lines and the subtotals. Sales minus cost of sales, 1,286,300. No adjustment on the cost of sales. We don't have to go back to the question paper to get that amount. It is there. We've already shown it on the answer sheet. 346,300. Discount received. We can just transfer that to the final column. If we add these, 34390. Gross profit plus other operating income will give us the gross operating income, 380,690. When we get to the expenses, no adjustment on these, so I can just transfer the amounts to the final column. If I add up all the expenses, 277,635. Gross operating income minus the operating expenses will give you the operating profit of 103,055 plus the interest income minus the interest expense of 47,670, and that will give us a net profit of 55,605. Just to show you from the top again, we start sales minus cost of sales will give you the gross profit. Gross profit plus other operating income will give you the gross operating income. You subtract the operating expenses in order to get the operating profit. You add the interest income to get the profit before interest expense, subtract the interest expense, and you get the net profit for the year. They've asked you to show the notes for interest expense. Interest on loan was the 29,000 plus the 17,500 to get to that 46,500, and interest on overdraft 1,170. So there is the total of your interest expense. And then also that question that they asked us, and we said that bank will be a current liability because it showed a credit balance, and that means it's a bank overdraft, a liability. We are moving on to the statement of financial position. Now, very often this one is a bit more difficult for you. You tend to get used to the statement of comprehensive income easily, but then this one is sometimes a challenge. DePaulo stores owned by Tandi DePaulo sells groceries to the residents, and this is our year end, the 30th of June, so we know our year started on the 1st of July 2020. We have to show these notes, and then we have to show the statement of financial position. The net profit that they give us is the final net profit, so we don't have to change that. We can just use it as is, and the adjustments will only impact the statement of financial position and the notes. Balances given, capital at the beginning, the loan at the beginning, fixed deposit not given, and then they start with the adjustments. The same as for the statement of comprehensive income, we must start with the format. Now in your workbook, trade and other receivables, it's a blank. So you must fill in debtors control. Remember, format. This is all about the format that you must study. You also have accrued income, prepaid expense. Those two are the assets. Trade and other payables, creditors, 199,000. We also have accrued expense, income received in advance. Those are the liabilities. Owner's equity, this is actually the capital account. The balance at the beginning, the net profit minus the drawings will give you the balance at the end. Statement of financial position, we will never give you a blank. There will always be some of the information given to you, but you must still know the whole format so that you can complete the missing parts. Non-current assets, fixed assets plus the fixed deposit. Fixed deposit was a question mark. Current assets, inventories, and they've given us inventories, the amount for trading stock, 133,600. Trade and other receivables, we do the note, cash and cash equivalents, they didn't give us any information on that. Equity and liabilities, owner's equity, we must show the note. There's a loan, the 290 that they gave us, trade and other payables, and the current part of the loan. Now we can go back to adjustment number 1, and we start with the adjustment. Remember, this is now step 2. We start with the adjustments in the order given. The first one, credit sales transaction of 24,500 on the last day was not taken into account, and the business uses a markup of 40%. Credit sales, this is in the debtors journal, term 1. We know that the debtors will increase because they owe me 24,500 more, and sales will be credited. But we're not doing the statement of comprehensive income, so we won't do anything with sales. We must also make an entry for cost of sales and trading stock because we are selling the stock. It decreases at cost price, 25,500 times 100 on 140 will give me the cost price of 17,500. I debit cost of sales and I credit trading stock. So on my balance sheet, debtors will increase and my trading stock will decrease. Number 2, we must write off an account as irrecoverable. Bad debts to be debited. It is an expense, will be shown on my statement of comprehensive income, and debtors control will be credited because a debtor decreases, and this must also be shown on the statement of financial position. So let's show that on the notes. Trading stock, inventories, we sold, so minus the 17,500, which is the cost price. And then we do have the note for trade and other receivables. Our debtors owe us 24,500 more, and we wrote off that one debtor, 7,200, in adjustment number 2. So that was adjustment 1 and 2. The third adjustment, insurance, includes an annual premium of 9,600 paid for the period the 1st of January until the 31st of December. So this was for a year. But we know our year ends on the 30th of June 2021. And if we draw our timeline again, we'll see 6 months. So we've paid for a year, January, February, March, April, May, June. 6 months is within my financial year, 6 months paid in advance. So we have paid in advance 4,800. In advance, we subtract from insurance, and this is a prepaid expense on the balance sheet. So this is what we show on the balance sheet. We do not do the income statement in this question. Adjustment number 4, the telephone account for June was still outstanding, and that is an accrued expense, which is a liability on the balance sheet to be shown. On the income statement, we would have added next to telephone, but we must show it on the balance sheet. Insurance was a prepaid expense, which is an asset, and then the telephone was an accrued expense. We still need to pay the telephone account. So those are the first four adjustments. Number 5. Interest on fixed deposit was not received for May and June. 2 months interest that we haven't received. The fixed deposit was invested on the 1st of October 2020, and interest is not capitalized. That means we receive the interest monthly. Our year starts the 1st of July 2020. August, September, October, November, December, January, February, March, April, May, June. This is the end of the financial year 2021. But we haven't received May and June yet. And we've only invested that on the 1st of October. So we are supposed to receive interest for 1, 2, 3, 4, 5, 6, 7, 9 months, but we haven't received that yet. So we've only received for 7 months. On the adjustment given, interest on investment, 16,100 is what was already received. But that was for 7 months, and we know 2 months is still receivable. So we still need to receive 4,600 Rand for interest on fixed deposit, which is accrued income, which is an asset. Trade and other receivables, accrued income, the 4,600 that we still need to receive for interest on fixed deposit. Number 6, the extra storeroom was rented out on the 1st of July 2020, the first day of this financial year. In other words, for the whole year. But the tenant paid the rent up until the 30th of September. Our year ends June, but we've already received for July, August, September. So we've received for 15 months, but we know these 3 months in advance. the rent income amount given, 212,800, at the beginning, information A, balance is given, rent income 212,800. But 3 out of those 15 months was in advance. So we've received rent in advance 42,560. Income received in advance. And that is a liability because they've already paid us the 42,000, but we still owe them the rent. Trade and other payables, income received in advance, 42,560. Now we get to depreciation. And this is note number 3. We've done calculation of depreciation on the income statement, but now we must be able to complete note number 3. Depreciation on vehicles, 15% per annum on the cost price. On equipment, 20% per annum, diminishing balance method. Make sure you apply the correct method with a percentage to the correct asset. And they also told us that new equipment was bought on the 1st of April. But they didn't say in the information given here what was the cost price of the new equipment bought. For this information, we need to go to note number 3. Important that you notice that we have 3 parts. Carrying value at the beginning, the movements, and then carrying value at the end. What was the carrying value at the beginning? Cost price minus accumulated depreciation. What happened during the year? Only 2 things. We can buy or depreciation to be written off, and that will give us the carrying value at the end. Cost price minus accumulated depreciation will give us the carrying value. So the difference between those 2 will be my accumulated depreciation at the beginning. Cost price minus accumulated depreciation will give you the carrying value. 196 plus the 283 will give you the cost price at the beginning. They told us that the new equipment was bought on the 1st of April. At the beginning we had equipment 480, at the end 650. So the 170, the difference between the 2, the increase from the beginning of the year to the end of the year, must be the new ones that we bought. And now we must start doing the calculations. Vehicles, they said that we write off depreciation on vehicles 15% per annum on the cost price. Vehicles, cost price given 1.2 million at 15%, 180,000. But we've seen that the carrying value is 120,000. So that is what it is worth, 120. If I subtract 180 from that, then I'm going to get a negative, and I can't have a negative carrying value. We are still using that vehicle, so it must be shown at a value of at least R1. So the most depreciation that I can write off is 119,999 Rand. So that the total accumulated depreciation at the beginning of the year, plus the new depreciation will give you 1,199,999 Rand. If we calculate the difference, it's a R1. So always be on the lookout for this one. Maybe you're not going to see it very often in grade 10, but in grade 11 and 12, definitely. The carrying value, the depreciation that you write off, can never be more than the carrying value. Equipment, again we must calculate separately the new equipment that we bought, 170,000, and that was at 20%, and we had it for 3 months. We bought that on the 1st of April, May, June. 3 months to give us the depreciation of 8,500. The old equipment, what we had for the whole year, we must write off on the diminishing balance method, in other words, on the carrying value, the 196,600, we had it for the whole year, 20% to give us 39,320. So the total depreciation on equipment is 47820. Depreciation at the beginning, accumulated depreciation, plus the depreciation written off this year will give you the total depreciation. Cost price minus accumulated depreciation will give you the carrying value. We know that the cost price at the beginning, 480, plus the 170 will give you the 650. We know that the accumulated depreciation at the beginning, plus the new depreciation will give you the accumulated depreciation at the end. Also notice carrying value at the beginning plus additions at cost minus depreciation at the end will give you carrying value at the end. That's another calculation that you can make. So the total carrying value of our assets will be the 3,187.80 plus the R1. Okay, so that's note number 3. Make sure that you understand it in grade 10. You will see it again in grade 11 and 12. Adjustment number 8. The loan statement received from Joe Bank revealed the following: balance at the beginning minus the payments plus the interest will give you the balance at the end. So there is my balance on my loan at the end of the year. Now if you look at the balance sheet, next to loan is only the 290. So they haven't subtracted the 40,000 that we've paid. They also haven't added the 22,000 interest that must be capitalized. And then at the bottom of that table, they tell us that an amount of 18,000 will be paid in the next financial year. So that is our current part or current portion of the loan, the 18,000. So that our loan amount is 254. If I add the 18,000, then I will get to that 272. But of that 272, 254 is non-current and 18 is a current portion of the loan. The last piece of information that they give us is that the current ratio is 1,521, and we know current ratio is the current assets towards the current liabilities. There's the 18,000 that will be repaid within the next year. They also give us the net profit, 78,000. Okay, now we're done with step 2. We've gone through all the adjustments in the sequence given. Now we must start completing our notes. Always work from the notes back to the balance sheet. Debtors control, we calculate that line total and we calculate this subtotal, 243,200. Trade and other receivables, only the 199,000. We add, we get this total 242,860. Owner's equity, they've given us the balance at the beginning, 240,000. They've given us the net profit, 78,000. They gave us the drawings, 56,000. Therefore, we know that owner's equity at the end of the year is 262,000. Those are the 4 notes that they asked us. Now we complete the balance sheet. Fixed assets, we said that will be the carrying value at the end of both. So I add the R1. They didn't give us anything on fixed deposits. Inventories, 116,100. Trade and other receivables, we've done the note. We just write the total in. They didn't give us any information on cash and cash equivalents. Owner's equity, we've done that one. We've done the note. So we can just fill in the amount. We've got the non-current liability, which is only the loan. And we've done trade and other payables. So we can just write in the total. So the bottom part can be completed. If we add these two, it will give us the current liabilities. And we know owner's equity plus the non-current liability plus the current liability will give me the total equity and liability, 776,860. But because we know that assets must be equal to owner's equity plus liabilities, we know that the total assets will also be 776,860. That will obviously earn you a method mark. The top part, we're still missing fixed deposit and cash equivalents with no information. But they did give us the current ratio. Current liabilities, we've calculated as 260,860. So the current assets will be 1,5 times that, 391,290. Current assets towards current liabilities, 1,5 to 1. We've got the 1. We've got the 260,860. So in order to get the 1,5, we just multiply by 1,5. If I have that total, now I can calculate cash and cash equivalents, 31,990. But because I have the total current assets, I know the total assets minus the current assets will give me the non-current. The non-current, 385,570. And I know the total of that must give me the 385, so this will be 66,789. Another method mark, another balancing figure that you had to calculate there. I hope this helps you with completing the statement of financial position and the statement of comprehensive income. Just again, please remember to study your formats so that you will be able to put the puzzle together with the pieces that we give you in a test or exam. The second part that we are going to look at is analysis and interpretation. After we've done the financial statements, we've done the income statement, we've done the balance sheet. But now we must use those two statements in order to do some calculations. We want information from that for the business. We want to plan ahead. We want to know which things needs attention. We want to know what is it that we must change in our business. And that is where the analysis and interpretation comes from. So let's see how I can help you with that. That is the purpose. That's why we do analysis and interpretation, to get information from these statements that we've done in order to plan ahead, in order to streamline our business. Please know and understand the indicators. We start with indicators in grade 10, we add some in grade 11, and we add more in grade 12. So make sure you know that in grade 10 already, because you're going to use the same indicators in grade 10 and 11 and 12. Know where to find the information. Very often you don't really know where to look for the information, and you page up and down in your question paper trying to find an amount which you are supposed to know where it is. Again, the format, very important. The indicators that we're going to look at: profitability and operating efficiency, there are 5 of them. Liquidity, this year we're only going to look at 2 liquidity ratios. Next year there will be more. Solvency, only 1, and then the return on investment, only 1. So there are 9 ratios that you need to study for grade 10, not that much. So please put in that effort. First one, the profitability and the operating efficiency. The question that we ask here is the normal operating activities of the business efficient? Operating activities, those activities that's got to do with the operating of the business, the buying and the selling, the normal operating activities. Is that efficient? And are they able to make a profit and control their expenses effectively? We start the income statement with sales, cost of sales, we get the gross profit, then we add income, subtract expenses. So are we able to control those expenses effectively so that we can make a profit? The first one, profitability and operating efficiency, the indicators. Percentage gross profit on sales. It's a percentage that you must calculate, so you have to multiply by 100. Gross profit on means divide by sales. So it's actually not necessary to study that indicator, because the name of the indicator actually tells you how to calculate. And remember, this will be on the formula sheet that you receive. Percentage gross profit on cost of sales. This is the markup percentage that we usually talk about, that the business is using a 25% or 60% or whatever. Percentage gross profit on cost of sales. Gross profit on cost of sales times 100, because we want to calculate these as percentages. The same for percentage operating profit. Remember, operating profit from your income statement before the interest income and the interest expenses. Percentage operating expenses on sales and the percentage net profit on sales. Operating expenses on sales. We want this to be as low as possible. For every R1 sales, we want the operating expenses to be as little as possible, so that of that R1 sales, we can keep as much as possible. So the percentage net profit on sales, obviously we want that one to be more. The operating profit on sales, we want that one to be more. So if there's an increase, it's good. But if there's an increase in the percentage operating expenses on sales, that's not good. Liquidity. The question that we ask for liquidity: is the business able to pay their immediate debt comfortably? Immediate, short-term debt. Can we pay our creditors? Do we have any cash flow problems? It can be that the business owns a lot of buildings, they have a lot of trading stock, but they don't have cash in the bank. And we need to pay our creditors with money. We can't pay them with trading stock. We can't pay them with a door from one of our buildings. We need to have cash for that. And that is where liquidity comes in. How liquid is the business? Can we cover our short-term debt, our immediate debt? If you think about liquidity, you think about liquid, you think about water. Do we have money available? Current ratio, asset test ratio. Current ratio, current assets towards your current liabilities. Asset test ratio, we subtract the trading stock towards the current liabilities. Current assets, we know we have the trading stock or the inventory, we have debtors, and we have cash. Now, why do we subtract trading stock? Cash is already cash. The debtors already have an obligation to pay us because we already sold to them. They must just pay us. But the trading stock, this is the one that we still need to sell in order to convert the trading stock into cash. So that's why we subtract trading stock, because of these three, it's the less liquid. Debtors already has obligation. Cash is already cash. That's why we subtract trading stock. Solvency, is the business able to pay all the debt? Not just the short term, not just the immediate debt, but all the debt. And there we have owner's equity and the net assets. Calculation of this, total assets divide by your total liabilities. Will you be able to cover all your debt if you sell all your assets? If this ratio is 1:1, it means if I sell all my assets, I will cover all my liabilities. If this ratio is 0.4:1, it means this business is insolvent. Because for every R1 liability, they only have 40 cents worth of assets. So even if they sell all their assets, they will not be able to cover the liabilities. And we know owner's equity equals assets minus liabilities. The next one, return on investment. The question there, does the owner earn a good return on his investment in the business? Remember, the other alternative is for the owner to invest his money in the bank. Just to put his money in the bank in a fixed deposit and earn interest on that. And the indicator we're looking at, percentage return on average equity. Return is the net profit, and average equity is the beginning, owner's equity at the beginning, plus the owner's equity at the end, divide by 2 or multiply by a half to give you the average equity. Because is it now at the beginning of the year or at the end of the year, the investment? That's why we calculate the average. How do we answer these questions in a test or exam? First, you identify and name the indicator. On the formula sheet, it will not say asset test ratio. You have to identify, you have to name the indicator. Then always, always, always show figures, amounts, ratios, percentages. Then compare with the previous year. Did this ratio improve? Did it weaken? What is acceptable and with what is it compared? Do we compare with the interest rate on the fixed deposit? What do we compare a certain ratio with? And then you have to give a general explanation or a comment on your findings. Activity 4 in your revision booklet, page 10 and 11, and in your answer book, page 9 and 10. Let's see what we can do there. They give us information from the books of Mocha Coffee Shop. Show all working details, always, 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 and give your answers. And there's another piece of information, first decimal. And the business obtains a profit markup of 65%. That means they add 65% to their cost price in order to calculate their selling price. We have to calculate. Now, this is non-negotiable. This must be full marks because it's only calculation. If you know your formulas, you know how to use your formula sheet, you know your formats, then that will always be full marks. And then they ask us some interpretation, 3 questions there. Just always check what is the previous year and what is the current year. Previous year, current year. Comprehensive income, sales, cost of sales, they actually do give us the gross profit, just the difference between those two. Other operating income, operating expenses, profit, interest, net profit. Statement of comprehensive of financial position, again previous year, current year. Fixed assets, fixed deposits, they give us a percentage there, interest rate 10%. Current assets, actually given because they gave us trading stock, trade and other receivables, cash and cash equivalents. So we can just add that. Owner's equity given, non-current liabilities, current liabilities given. Then they also give us financial indicators for the previous year because it's 2021. Current ratio was 1,3 to 1, asset test ratio was 0,7 to 1, and the return on owner's equity 39%. Calculate the percentage gross profit on cost of sales. Gross profit is sales minus cost of sales. They haven't given us the gross profit, but we know sales minus cost of sales. Remember, this is now for 2022. Divide by cost of sales times 100 will give you the markup percentage on cost of sales. Number 2, we have to calculate the net profit as a percentage of turnover. Now, turnover is equal to sales. Just another word for sales. The net profit, they've given us the net profit. 231,040. On turnover, on the sales, 760,000 times 100, 30.4%. What does that mean? For every R1 sales, we kept 30.4 cents as net profit. Where's the rest? The rest is in expenses. So this is the meaning of that 30.4%. R1 sales, we keep 30.4 cents as net profit. The next one, current ratio. Current ratio, current assets towards current liabilities. But we said they didn't give us the current assets, but they did give us those 3. So we can just add them. Just to show you the net profit, there was the net profit, 231,040. There's the sales. Something else that I just want to emphasize again, that heading, calculate the following for the year ended the 28th of February 2022. So that is how you know that you must look at the 2022 columns. Current assets, trading stock, plus trade and other receivables, plus cash and cash equivalents towards the current liabilities. If you add that, you can get 64210 towards your current liabilities, and that will give you a ratio of 2.821. That means for every R1 current liability, you have R2.80 current asset. But now, just to make sure that included in that is not too much trading stock, we take trading stock out of the equation when we do the asset test ratio. So then it will only be trade and other debtors plus cash and cash equivalents towards the current liabilities. And that will give you an answer of 1.521. You can also say if the 64210 was the total current assets, then you can just subtract the trading stock from that towards your current liabilities, and that will also give you 1,521, the same answer. The next one, the return on average owner's equity. Remember we said return is the net profit, 231040, that was given. Average owner's equity. Owner's equity at the beginning, which was given, owner's equity at the beginning, end of the previous year, plus at the end, 83716, multiply by 100 to give us 28,1%. 14,1. So that is the return. Like I said, this is supposed to be full marks for this one. Now for the interpretation. 4.2, they ask us, do you think that Mocha Coffee Shop is satisfied with the gross profit percentage on cost of sales? Remember, we calculated that as 60%. But in that very first sentence, they said that the business is using a markup of 65%, but now they only achieved 60%. We also have to comment, quote figures. Why is this? There could be something like sales, specials, trade discount on goods. That means we are selling at less than cost price plus 65%. Why? Because we just want to get rid of the stock. So at the end, we will not achieve the 65%. It can also be that the goods marked incorrectly. In other words, the selling price was calculated incorrectly. Therefore, at the end, the gross profit markup that we achieve will still not be the 65%, but only 60%. 4.3, they ask you to comment on the liquidity on your formula sheet. They will not give you a heading liquidity. You must know which two ratios refer to liquidity. You have to quote two financial indicators with figures. Current ratio increased from 1,321 to 2,821. So there was an improvement. That's good. The asset test ratio also increased, so that's also good. So the conclusion is that the business will be able to settle their short-term debt. They will not have problems settling their current debt. Remember also on the formula sheet, they won't say current ratio. There will just be current assets towards current liabilities. That's all that they give you. You must know which indicator refers to which calculation. And then the last question, they ask you if Mocha Coffee Shop must be satisfied with the return on owner's equity. Comment through quoting figures to support your answer. We saw that the previous year, the percentage was 39%, and now we've calculated it as 28,1%. So there was a decrease, but we know that the owner must still be satisfied because it's still more than the percentage on the fixed deposit that he will earn at the bank. This is supposed to be 28,14% is still more than what they receive at the bank, the 10%. So if the owner took his money, put it in the bank, he would have received or earned 10% on his investment. Now he's taken a risk, a higher risk, and he earns 28,14%, which is still very good. Last year, yes, it was 39. This year it decreased, but it is still more than the 10% that he would have received from the bank. Analysis and interpretation. Sometimes you think it's a difficult topic, but please, if you start in grade 10 already to understand and to know where to find the information, This will help you in grade 11 and 12 as well. And I hope that this helped you explaining the indicators and showing you how to calculate them. Our third topic for this revision is on VAT. It's important that you remember that VAT is actually a very bigger topic than what we do at school level. School level, grade 10 specifically, you only need to know the terminology, the theory part, and then the basic calculations of VAT. But in practice, VAT can actually be a topic that you specialize on, but we're only looking at a small part at school. So let's see what you must know about VAT. You must know what it stands for, value added tax. In the process, each time a value is added to a product, there must be paid VAT on that amount. Why do we have VAT? Remember, we have direct taxes that is paid directly to SARS. Now that will be on income received. The more you receive, the more income, the more tax you pay. But VAT is an indirect tax. We pay this when we spend money. This is paid by everybody. Indirectly, because when we buy at Pick n Pay, we don't pay SARS directly, we pay through Pick n Pay. Pick n Pay must pay that VAT over to SARS. So that is an indirect tax, and obviously taxes is there so that certain products and services infrastructure can be supplied by the government. Registration, if you have a turnover of more than R1 million per year, per annum, then you must register as a VAT vendor. If it's less than that, more than 50,000, then you are allowed to apply to voluntary register as a VAT vendor. That means you are charging VAT and you are gathering VAT on behalf of SARS. Doesn't mean that the VAT belongs to you, it still belongs to SARS. Then we have these three rates, zero rated items, exempted items, and then the third one that you sometimes forget is the standard rate, the 15%. The next thing is you sometimes get confused between zero rated and exempted. Zero rated, there's a zero. Charged at 0%. And because of that zero, you will remember that looks like an egg. And egg is some of the necessities, basic necessities that people need. Therefore, there's VAT charged on that, but only at 0%. And then exempted items will be the school fees, will be salaries and journals, salary and wages. That will be your fuel levy, subject to other taxes. But those are the exempted. Zero will be your necessities, your eggs, your fresh fruit and vegetables, your breads. And then standard rate, all the rest, 15% on that. Output VAT versus input VAT. Now, very often in grade 10, we ask you to explain the difference between these two. Output VAT is charged on goods sold. I cannot pay output VAT. I charge, the business charge output VAT on goods that they sell. Input VAT is paid on goods purchased. So when we as a business are registered as a VAT vendor, we buy trading stock, we pay input VAT. And that can be claimed back from SARS. And then normally we just make the calculation, output minus input, and then we see how much we owe SARS, or maybe SARS owe us money. We owe SARS the output, but SARS owes us the input. So instead of us paying SARS and SARS paying us, we just calculate the difference and we pay the difference over to SARS or if we've paid more than what we've charged, then SARS must owe us money. The next two, inclusive versus exclusive. If we talk about inclusive, it means VAT is included in that amount. Without VAT is 100, then we add the 15 VAT, and then we get the 115. This is exclusive, this is inclusive. That's why for inclusive, if we want to calculate the VAT, we multiply by 15 on 115 times the amount. Exclusive, VAT is not included, so then we multiply by 15 on 100, because 100 is excluded. VAT is not included in that amount. VAT payable to SARS will increase with sales, discount that we receive from our creditors, returns to creditors, bad debts recovered, and drawings. Now, this we will have a closer look at in grade 11 and 12. Important now is that when I have sales, we charge output VAT, and output VAT is payable to SARS. So that will increase the amount payable to SARS. The amount payable to SARS will decrease by purchases that we made, discount allowed to debtors, returns by debtors, and bad debts. Again, these three we will look at in grade 11 and 12. For now, purchases, we know we pay input VAT, and input VAT can be claimed back from SARS. So that will decrease the amount payable to SARS. And then ethics, whenever it comes to VAT, there will always be questions on, is it the right thing? Must the owner do this or that? Or what will your advice be to the owner? When it comes to VAT, remember ethics, it's always about doing the right thing. Even if we feel it's too much, it's not for us to decide, we must pay over that VAT to SARS, because VAT belongs to SARS. Always do the right thing. Activity 6 in your revision booklet, that is on page 13, answer book also on page 13. They ask us 4 questions on VAT, and you just have to say true or false. VAT is a fair form of taxation? Yes, because everybody is paying that. If you spend money, if you buy from the shop, then you pay VAT. So everybody is paying it, so it's fair. The current percentage is 14%. No, it was 14. It is 15% currently. Fresh meat is an example of VAT exempt item. No, that's false. And the difference between output VAT and input VAT is the amount payable. That's true. Calculations. Always before you start, just identify the columns. VAT exclusive is the 100. VAT inclusive is the 115, and the VAT amount is the 15. The order of these columns, they can differ. That's why read the headings, indicate which one is the 100, the 115, or the 15. We have 5,600. They ask us to calculate the 115. That is what they ask us. What did they give us? They gave us the 100. And there's my calculation. 6440. Inclusive of VAT must always be more than exclusive. Number B, they've given me 19550. They ask me to calculate the 100. What did they give me? They gave me the 115th. Unknown on the known, and that will give us 17,000. Again, exclusive of VAT, less than inclusive. Number C, we have the 21,000 to work with. They ask us the 15. What they've given us is the 100. So 21,000 times 15 on 100, and there is your VAT amount. That is the 3 basic calculations for VAT. Eureka traders registered for VAT. Standard VAT rate applies, and we just have to indicate each one of these, either 0 rated or VAT exempt. School fees, it's not an essential food, therefore exempted. Dried beans, 0 rated. Salaries and wages, we actually have income tax on salaries and wages. Brown bread, necessity, therefore 0 rated, and fruit also 0 rated. 0 rated, remember the egg is 0%, eggs, basic necessities. And then the last question, the owner asked for your advice. He wants to collect VAT and not pay it over to SARS because he sees VAT as part of his profit. Is it acceptable? Doesn't matter how you feel, the answer is always no, because this is unethical. It's fraud. You cannot collect money that belongs to SARS and keep that for yourself, because VAT belongs to SARS and not to the business. It's always good to do the right thing. With the VAT, collect the VAT and pay it over to SARS. The moment that you start being dishonest, then it becomes a problem. So always, with your VAT calculation, with your VAT answers of these questions, always refer to ethics, always refer to fraud. It's illegal. I hope this helps you to understand VAT better so that you can do your calculations, and remember to study your theory of VAT. We are at the last topic of our revision, and this is on cost calculations. When we manufacture, when we make something, how do we calculate the costs involved in making these products? Types of businesses. In grade 8, we taught you about a service enterprise, where we deliver a service and then we receive money for that. Then from grade 9, we've done the trading enterprise, where we buy goods at a certain price, we add profit and we sell it at a higher price. But now we are looking at a manufacturing enterprise where we make the product. Before we can decide on a selling price, we must most certainly first calculate how much it cost us to produce the product. Costs that we are referring to: material cost, the labor cost, factory overheads, as well as admin cost and sales and distribution cost. Now, material cost, labor cost, factory cost, those are the costs that will determine the production cost. Admin and sales and distribution costs, these are costs that will decrease my profit, but it's not connected to the manufacturing process. So those will appear, these two will appear on the income statement, but these three will determine the production cost. If you look at material and labor, we have direct material and we have indirect material, the raw materials that we use. If I am making tables, then I know exactly how much wood I need per table. I can identify that wood in the final product. That is direct material. Indirect material, I don't know how much varnish I use per table. I don't know how much glue I use per table, but that's also used in making, material used in making or producing the final product. So that is why it is indirect material. If we are making clothes, the material, the fabric, will be direct material, but the cotton that we use, that will be indirect, because we don't know specifically how much we need per item. Difference between direct labor and indirect labor. Direct labor, the people involved in the production process, those people that are putting the table together. While the indirect labor will be people in the factory, yes, but that will be the cleaners. They're not involved, they're not making the product, but they are in the factory. And it can also be the factory manager, it can also be the supervisor in the factory, not involved in making, but they are in the factory. Factory overheads, all the other costs, indirect material, the indirect labor. Also your rent expense, depreciation, repairs, insurance, water and electricity. And obviously only with regard to what happens in the factory. Not in the admin office, not in the sales and distribution, but only the rent for the factory, the depreciation on the factory equipment that is used. Calculations that you must be able to do. We say prime cost, direct material plus direct labor. Your total production cost is then your prime cost, which is your direct material, direct labor, plus the factory overheads. Remember that we said that the costs, material, labor, factory overheads, and those will form your total production cost. Material can be direct, indirect, labor can be direct, indirect. Prime cost is the direct costs, and the indirect labor and indirect material is included in the factory overheads. And then lastly, the unit cost, the total production cost divided by the number of units that you produced. So then you can calculate how much does it cost you to produce 1 unit of the product, so that you can then add your markup percentage to calculate your selling price. Fixed cost versus variable cost. Fixed cost is cost that will stay the same irrespective of the number of items produced. Now, if you see on this graph, there's your fixed cost. The number of units produced will increase, but my fixed cost just stays the same. Your variable cost will differ. There's your variable cost. The more you produce, the more the cost. So variable cost that will differ according to the number of units produced. Fixed cost will stay the same irrespective of the number of units produced. Our fixed cost will be factory overheads and the admin cost. If you think about the rent, if the rent is 5,000 Rand per month, I have to pay the 5,000 Rand, irrespective of how much I produced in the factory. That is the rent. Variable cost, direct material, direct labor, and sales and distribution cost. If I pay my sales people commission on the sales, obviously the more sales, the more the commission. Or the more sales, the more distribution, the more the fuel cost. So that will be variable cost. Activity 7, page 14 in your revision booklet as well as in your answer book. First question, we have to match column A to column B. Very often it's easier to read the explanation in column B and then find the correct term in column A. The running costs of the factory. The running costs, that will be your overheads, factory overheads. So number 2 is A. The raw material actually needed to make the product, that will be your direct material, and nowhere is there a direct material. Costs related to and easily traced on the making of a product, that will be your direct cost, direct material, and direct labor. Costs that change depending on the number of units produced, that will be your variable cost. The more you produce, the more the costs. And then costs do not change even if the quantity produced by the factory increased or decreased. That will be your fixed cost. And between D and E, you have your definition for fixed cost and variable cost. 7.2, Tiny Peters owns a small manufacturing enterprise called Tiny's Custom Made Furnishers. Then in January 2022, the principal of Silver Sands Primary School requested Tiny to make 40 special tables for the new art center. So we know we are making 40 tables, and we have to do some calculations. Information given: the material cost to manufacture the 40 tables. So this will all be material. Direct material. Then Tiny works from a small factory. There's the rent. That will be factory overheads. His water and electricity bill, that will also be factory overheads. Then he pays 250 Rand for a casual employee for each table produced. That will be direct labor. And then again, 40 tables were produced during January. First calculation, calculate the direct material cost. All those costs, if we add that, and always just write your calculation, 5,500 plus the 1,100, the 300, 500, and the 600, the material cost adds up to 24,000. Direct labor, he pays an employee 250 Rand per table, and they are making 40 tables, therefore direct labor 10,000. Prime cost, these two added, 24,000 plus the 10,000. Always write your calculation to earn method marks, 34,000. Total cost of production is the prime cost, which we've calculated, plus the overheads. 11,000 for the rent, and water and electricity, 1,800. So there's the total cost of production, 46,800. The unit cost, that was the total cost of production for how many units? For 40 tables. So per unit, it is 1,170 Rand that it costs to produce one table. And now he can decide on a profit markup to be added to that in order to get the selling price that he will sell the tables for. For your manufacturing or your cost calculations, you must know the theory. Please know the different concepts and also being able to identify them, and then also just to do some basic calculations of the total cost of production. And I trust that this helped you to understand manufacturing better, and we know that you are going to do well in this section in your question paper at the end of the year.